Reality is the final arbiter. The weighing machine has finally arrived. As Benjamin Graham famously said, the market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. For investors who aggressively accumulated Merck & Co. near the $78 to $83 range in 2024 and 2025, the contrarian bet looked stupid. It looked stupid to a market intoxicated by weight loss drugs and AI chips. While the herd chased valuation multiples of 50 times earnings, the rational capital allocator was buying a 130-year-old pharmaceutical giant at a discount. Today, with the stock trading at around $121, those positions are no longer suffering, they are vindicated. The voting machine of the market has sobered up, and the weighing machine has taken over. The question now shifts from accumulation to management. Is it too hot? Should I sell? The RSI is elevated, the price has run, but to sell a high-quality asset simply because it has reached fair value is a cardinal sin of capital allocation. It is akin to watering the weeds and cutting the flowers. This report is an autopsy of the business as it stands today, stripped of emotion, focused entirely on the physics of capital. Part 1. The Pit Stop Quarter. If Wall Street were a person, it would be a toddler who just dropped its ice cream cone. It screams about the mess on the floor, Gardasil and China, while completely ignoring the fact that it still has a giant birthday cake on the table, Keytruda and Winavir. The 2025 Q4 and full-year results weren't bad, they were complicated. And if there is one thing algorithmic traders hate, it's having to open a PDF and actually read the footnotes. Management didn't throw the kitchen sink at us. Rather, they pulled the car into the pit stop. They slowed down headline growth to 1% to change the tires, write off bad assets, and refuel, acquire new biotechs. Why? So they can survive the race in 2028. The ugly headline, Why the Stock Wobbled. Let's address the elephant in the room, or rather, the dragon, China. The narrative screamed, Merck's growth is dead, revenue only grew 1%, but the reality? The entire slowdown was caused by a single product line in a single country. The culprit? Gardasil sales cratered minus 39% due to an anti-corruption crackdown. The verdict? This is a flesh wound, not organ failure. If you strip out the China vaccine volatility, the rest of the business grew at a healthy mid-single-digit clip. Where did the cash go? Invested, not wasted. A common bearish argument is Merck's GAAP profits are low, they're burning cash. Look at the capital allocation strategy. They're not lighting money on fire, they're buying insurance against the 2028 patent cliff. Dividends? $8.2 billion returned to shareholders, including you. R&D and deals? Over $13 billion plowed back into buying companies like Harpoon and Acceleron. The strategic verdict is clear. Merck is trading short-term GAAP profitability for long-term survival. They're using the massive cash flows from Keytruda today to buy the drugs that will save your portfolio in 2030. Part 2. Animal Health, the crown jewel hidden in the dirt. Most analysts treat Merck Animal Health as a rounding error. In reality, it is one of the highest quality business segments in the entire S&P 500. Why is this segment the secret weapon of your portfolio? First, the physics of the fur baby economy. Human pharmaceuticals are plagued by the patent cliff. You spend billions, get 10 years of profits, and then generics destroy you. Animal health is different. It is a brand loyalty moat. Livestock resilience means farmers do not switch vaccines to save pennies. If a herd dies, they go bankrupt. This is sticky revenue. Companion animal stability remains robust. Second, the valuation arbitrage. If you spun off Merck Animal Health as a standalone company like Zoetis, the market would assign it a PE multiple of 30 to 35 times. $6 billion in revenue implies a $75 billion market cap. The math? At the $81 entry price, I essentially paid for the oncology business and got the animal health business for free. That is the definition of a margin of safety. Part 3. The 2028 Cliff, Keytruda, and the AbbVie Playbook. Let's address the elephant in the room, Keytruda. 48.6% of revenue comes from Keytruda. This pie chart is what scares the first-level thinkers. They see the pink section and scream risk because the patent expires in 2028. Second-level thinking suggests this is actually an AbbVie Humira moment. The historical parallel. When Lipitor expired, Pfizer had nothing ready. Revenue tanked. But when Humira expired, AbbVie had spent years building replacements. When the cliff came, the stock hit all-time highs. Merck is executing the AbbVie playbook. The strategy is clear. 1. Winrevair, launched in 2024. This is the ace. Analysts project peak sales of $6 to $10 billion. This singular drug is capable of backfilling 30% of the Keytruda loss alone. 2. Keytruda sub-Q, scheduled for 2025. By converting patients to a new injectable form, they effectively push the cliff back by a decade. You are not holding a dying star. You are holding a company in the middle of a strategic metamorphosis. Part 4. Valuation. Is 121 too hot? RSI is hot, but price is not value. Let's look at the cold, hard multiples compared to the competition. We're not comparing Merck to the market. We're comparing it to its peers to see where the smart money flows. The Icarus trade, Eli Lilly. It is priced for absolute perfection. But Merck is priced for reality. This analysis comes from the desk of the Atlas Shrug capitalist. I am not an algorithm. I am a value investing stock picker with an 18% compounded annual growth rate over the last 6 years. I don't follow the herd. I hunt for the anomalies the herd ignores. I provide deep dive consultations and analysis for serious investors. You can find all my work, my portfolio updates, and my unfiltered thoughts on Substack and X.com. I will leave you with this. The market will scream. The market will panic. The market will try to shake you out of your conviction. But as John Galt said, do not let your fire go out. Spark in an irreplaceable spark in the hopeless swamps of the not quite, the not yet, and the not at all. Do not let the hero in your soul perish in lonely frustration for the life you deserved and have never been able to reach. The world you desire can be won. It exists. It is real. It is possible. It's yours. Stay rational.